huge quarter, blowout numbers across the board. They even raised guidance, but you have Netflix at peer perform. So you think Netflix is equal to the other streaming services? Why are you only at peer perform?
I thought you might lead with that. We really think Netflix is an expected return that ought to be something like the stock market going forward. The stock at 40 times free cash flow is very much a point of view on what will happen in the future as opposed to what just happened. This quarter was absolutely fantastic, and last year was fantastic, and we'll have carryover benefits from that in the next few months, and the stock's reaction today makes sense to us. What'll matter the most for investors who buy the stock today at the price near 1,000 will be the growth rate at the end of 2025 and into 2026.
All right. So in all fairness, your peers have it at outperform, but they do have a price target that's below where the stock's trading at right now. One thing I want to hit on is that raise of guidance despite the stronger dollar. Isn't that a sign of very strong demand, the fact that the dollar got stronger, but even in international markets, this company continues to see gains?
It is. And the company put through a pretty aggressive price increase yesterday in North America. That's very important to the guidance that they've offered. And the reality is Netflix offers good value. The base plan is going to be $18 this year. The premium plan now $25. So the days of Netflix being an $8 a month easy decision are gone. But Netflix has put itself in a position to test the outer limits of consumer willingness to pay by launching this advertising tier that still is $8 a month, heading towards $9. And so there's some sort of a tier for everybody these days.
So you have it at peer perform. What does this report and the peer perform rating, what does that say about the rest of the companies in this space? It seems like that streaming, it's just a bit stickier than we all thought it was. We all thought that people would kind of hop from service to service or sign on and cancel after big events. But according to Netflix, they signed up for the Jake Paul-Mike Tyson fight and they just kind of stayed. What is this telling us about the rest of the area?
Well, churn is actually a huge problem for streamers not named Netflix or Amazon or YouTube for various reasons. And so the rest of streaming is still under enormous pressure and to get together and bundle. And the bundling trend involves mergers. It involves synthetic bundles in which companies get together and offer their products together, even though they're separate and really competitors. And that's essential when you have a smaller share of the consumer's wallet and they can live without you. But Netflix has got about 15% or 17% of total streaming minutes in North America, and that's why their churn rate's low.
All right, Peter, we do have to go, but give us the name that you see as the most vulnerable to this churn that you're talking about.
Oh, Paramount has long struggled with high churn and low price per month, and it's because the offering is pretty narrow. CBS is an important component of Paramount. People will watch it for football. They watch it for other sports offerings during the year. And if you strip CBS out of Paramount, it's an even tougher position. And so we think David Ellison has his work cut out for him. And that's why we have an underperform rating on that stock.